On an autumn morning in the year 2000, two casually dressed men walked into the 27th floor of a Dallas skyscraper. Their names were Marc Randolph and Reed Hastings. They were not there to apply for a job, but to sell their struggling startup, which was bleeding cash in the wake of the dot-com crash. Sitting across the massive glass table was John Antioco, CEO of the entertainment titan that dominated the globe, Blockbuster. Hastings made a straightforward offer. Blockbuster would buy his startup for $50 million. In return, the startup team would build, manage, and scale an online video rental platform for Blockbuster, while Blockbuster's vast retail network remained the primary distribution hub. Hearing the $50 million price tag, John Antioco and his executive team could barely keep a straight face. To them, paying $50 million for a tiny business mailing DVD discs in envelopes was an absurd joke. The meeting wrapped up in minutes. The offer was flatly rejected. That small, discarded startup was Netflix. 20 years later, Netflix commanded a market valuation exceeding $200 billion, fundamentally altering how billions consume entertainment worldwide. Meanwhile, Blockbuster, a retail empire that once operated 9,000 stores with 80,000 employees, collapsed, leaving behind just a single franchised outpost in Bend, Oregon. Popular culture often paints this rejection as one of the most foolish blunders in corporate history. Yet a closer look at the financial statements and market dynamics of 2000 reveals that Blockbuster's decision was far from irrational. It was anchored in sound, conventional business logic for its era, a fatal trap known across corporate strategy as the Innovator's dilemma. How did an industry powerhouse like Blockbuster get trapped by its own success? And what were the real economics behind that $50 million rejection? The money machine. To understand why Blockbuster turned down Netflix, one must examine the scale of its dominance at its peak. Throughout the 1990s, Blockbuster was not simply a video rental business, it was a weekly family ritual across America and beyond. The concept of Blockbuster Night was a bona fide cultural phenomenon. Blockbuster's business model relied on three core pillars: convenient physical store locations, abundant stock of new Hollywood releases, and most critically, rapid inventory turnover. However, a well-known financial reality underpinned Blockbuster's balance sheet. Out of its billions in annual revenue, roughly $800 million, nearly 16% of total revenue, did not come from base rental fees, but from late return penalties. The mechanism was straightforward. Rent a movie for 2 days and return it the following weekend, and the accumulated late fee at checkout often exceeded the original rental price. While customers detested the penalties, for Blockbuster's management and shareholders, late fees were a high-margin cash engine with virtually zero incremental operating cost, a near 100% gross profit margin. This created a severely misaligned incentive. Blockbuster profited every time a customer forgot to return a tape on schedule. Company revenue growth was inextricably tied to consumer frustration. The envelope that broke the system. This structural vulnerability created the opening Reed Hastings and Marc Randolph needed. When they launched Netflix in 1997, its entire value proposition was built to dismantle Blockbuster's penalty-driven model. Netflix introduced an unlimited flat-rate monthly subscription. Customers queued the movies they wanted online, received thin DVD mailers in their mailboxes, and could keep them as long as they pleased without incurring a single cent in late fees. Once finished, they simply dropped the DVD into any outgoing mailbox to trigger the shipment of the next title on their list. To Blockbuster's CEO, John Antioco in 2000, however, Netflix's operational model looked like a blueprint for bankruptcy rather than the future of entertainment. Consider the landscape from Blockbuster's perspective. First, the DVD market was in its infancy. Most American households still relied on VHS tapes. Committing massive capital to DVD by mail logistics seemed premature and high risk. Second, Netflix in 2000 was losing roughly $60 million a year with a subscriber base of only about 300,000 users. In the midst of hundreds of dot-com companies failing, spending $50 million in cash to acquire an unprofitable internet startup was viewed as fiscal recklessness by Wall Street. Third, and most critically, had Blockbuster acquired Netflix and adopted the no-late-fee subscription framework, it would have wiped out $800 million in pure profit overnight. No public company CEO could realistically walk into a board meeting and propose eliminating 16% of the company's highest margin revenue stream to pursue an unproven internet trend. The counterattack and the fatal debt. Contrary to popular belief, Blockbuster did not sit entirely idle. By 2004, with broadband expanding and DVDs overtaking VHS, John Antioco recognized that Netflix posed a genuine threat. Blockbuster mounted an aggressive counteroffensive, Blockbuster Total Access. It was a clever hybrid model, allowing customers to rent movies online and exchange them instantly at physical stores without waiting for postal delivery. The strategy gained immediate traction. Total Access quickly amassed millions of subscribers, putting Netflix on the defensive for the first time. Yet, this market share battle proved ruinously expensive. To run Total Access and compete with Netflix on price, Blockbuster eliminated late fees and poured hundreds of millions into digital promotions and logistics subsidies, severely eroding cash flow. Simultaneously, Blockbuster was saddled with roughly $1 billion in legacy debt, stemming from its spin-off from parent company Viacom. Franchisees grew hostile as physical store operations were strained to support online customers without a viable profit-sharing arrangement. Alarmed by declining cash reserves, activist investor Carl Icahn led a boardroom revolt, arguing that Total Access was burning valuable capital. In 2007, John Antioco was forced out as CEO. The incoming leadership immediately halted online subsidies, reinstated store fees, and redirected focus toward maximizing short-term cash flow from brick-and-mortar locations. It was the point of no return. The final collapse and the lesson. That same year, as Blockbuster retreated to protect its store footprint, Netflix initiated a far more consequential transition, shifting focus from DVD mailers to digital on-demand streaming over high-speed internet. As broadband infrastructure scaled globally, Blockbuster was depleted of cash and trapped beneath a billion-dollar debt burden it could no longer service. Its expansive physical footprint turned from a core competitive advantage into an unsustainable lease liability. In September 2010, 10 years after turning down Reed Hastings' $50 million proposal, Blockbuster filed for Chapter 11 bankruptcy. The collapse of Blockbuster leaves an enduring corporate lesson. Market leaders are rarely dismantled overnight by emerging technologies alone. They falter because their existing business models are too profitable to sacrifice for the unproven future. Blockbuster rejected Netflix not because it failed to see where the market was heading, but because its present was too lucrative to disrupt. In corporate strategy, a reluctance to cannibalize your own revenue is the fastest way to let a competitor do it for you. Outrow, which major company today do you think is facing its own Blockbuster moment? Share your thoughts in the comments below.